Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report. Today we're going to have a look at two things, productivity and debt, because we've had some big numbers over the last week and it's time to dig a bit deeper into what's happening there. Firstly, productivity. We can work out what our productivity has been per hour worked by looking at the GDP stats that came out last Friday. And they show, as you can see here from this chart, that our productivity has dropped sharply in the last year or two. And in fact, it's been on a downtrend since 2002. A couple of reasons we think for this. Essentially, we've started to pull people into the workforce who aren't quite as productive. They may have been unemployed. We haven't invested enough in new capital to make our labour more productive per hour worked. And some people say, including me, that the sharp increase in the public sector, the government, and the number of people employed there has also reduced our productivity. Now this measure, as you can see up here, actually measures, it's a very crude measure, just simply takes the amount of output divided by the number of hours worked. So it doesn't actually separate out labour productivity from capital productivity. Let's have another look here at productivity. This is a longer term series here and you can see what's happened over the last 20 years or so. It shows that productivity bumbled around a bit between 1980, mid-1990s, blipped up briefly in 2000 but has been falling ever since. You can see here since 2000, and basically we don't have any productivity growth. You really need productivity growth to grow your economy. And it's clear that over the last decade or so, our productivity has not improved at all, despite various attempts to improve it. Now let's look at our next stat here, overseas debt. And you can see from this chart that our overseas debt over the particularly last 4 or 5 years, has jumped sharply. This is all about New Zealanders borrowing from people overseas to take out mortgages and buy each other's houses, and in some cases to build new houses. But increasingly over the last 4 years, it's not to build new houses, it's just simply to invest in each other's property. That's pushed up property prices. And we've seen this reflected in our level of overseas debt. You can see here from this chart, back in the early 90s, we had quite a bit of government debt. That has actually been dropping. If there's been any culprits in the last few years, it's not the government. It has reduced its debt. It has been Joe Public taking out mortgages to buy each other's houses. That's reflected in what's called corporate debt, which actually mostly is bank debt. So we borrow money from our banks, they borrow it from foreign investors. And you can see here in the last 5 years, we've jumped from about 100% to 123%. That growth in our overseas debt is the fastest we have seen in our history as a nation. And it's certainly the highest we've ever had. Now you can see here that this has increased our debt sharply and increased the amount of money we have to use up from our export receipts to pay for the interest on that debt every 3 months or so. And if you look at the income deficit, so how much of a deficit we have to pay out every month in interest payments and also profits on investments here, that's risen from 16% 6 years ago, so 16 cents in every dollar earned overseas we had to spend on servicing our debts. That's now up to 26%. And if you look at our pure debt servicing ratio of export receipts to debt costs, that's up to 16.7%. That's the highest since 1999. And you've got to remember, back in the late 90s, our currency was falling out of bed, in large part because of this, because we'd taken on too much debt. And some people say that our New Zealand dollar will fall because of that. Another thing to look at is how much debt are we having to roll over every 90 days. So this is something the Reserve Bank has warned on, that we are so much in debt to foreign investors, and it's mostly short-term debt. And what does that mean? It means that every 90 days we have to go to our foreign investors and say, can you let us have that money please for another 90 days? That makes us vulnerable to one day when they say, no, we want the money back now. So let's have a look at the amount of debt that rolls over every 90 days. Currently it's at $61.1 billion. That's 34% of annual GDP. And it's actually almost twice as much as our GDP per quarter. So 90 days is a quarter. That means $61 billion. If foreign investors decided not to roll that over, we simply couldn't pay for it. We wouldn't be able to service our debts. Now that's highly unlikely, but it shows how vulnerable we are to foreign investor sentiment. That amount is also 4 times more than our export receipts in a quarter. We make about $14 billion every 90 days from our exports. Yet, the amount of debt we have to roll over is 4 times larger than that. It shows how exposed we are to foreign investor sentiment and shows how much we've built up our debts over the last 4 to 5 years. Also shows how vulnerable our currency is. I'm Bernard Hickey. That was an economic weather report from interest.co.nz.